Our next guest says despite signs of strength for the consumer, investors are still betting on a big breakdown in the market. Let's bring in Mandy Su of Credit Suisse. Mandy, great to see you.
Hey, Melissa. It's great to be on the show.
What are you seeing in the derivatives market that makes you believe this?
So I would say, you guys mentioned the wall of worry. That is exactly what we're seeing in the options market. So what stands out to us is that even though, we've had what I would characterize as a relatively minor pullback, and even though levels of volatility are still fairly contained, other metrics in the option market are all at extremes. And in particular, the one that we look at very closely is called skew. And what essentially it measures is the relative demand for downside puts versus upside calls. So when that measure is at a high, which it is today, what it tells you is that people are pricing in a lot of downside risk, getting very bearish, putting on a lot of hedges, and not buying a lot of upside calls. And that's exactly what we're seeing. So not only are markets pricing a lot of downside risk, but also very pessimistic about a further upside potential from here going into the year end. So the upside calls are also trading very, very cheap relative to the downside puts.
So where are the greatest opportunities in terms of buying calls or making bullish bets on the market in certain sectors, Mandy?
Sure. So if you look at kind of where that bullish sentiment has really diminished over the past few months, it's really come from the cyclical sectors. And just to throw some stats out there. So back in April of this year, about half the stocks in the energy sector were trading with what we call inverted call skew, which is just a measure of very extreme bullish sentiment, right? A lot of demand for those upside calls. 50% of the stocks in the energy sector back in April were trading with this characteristic. Today, it's 0%. Whereas if you look at, for example, comm services or some more defensive sectors, that bullish sentiment is still, it's come down a little bit, but it's still very prevalent. So I would say in terms of where expectations have gotten really taken down, where we're seeing the most pessimism, it's very much in the cyclical sectors. And we think it's overdone at this point. So kind of on a risk reward basis, we like looking at upside calls, particularly in energy, industrials, and financials, the really cyclical sectors to play a rally into year end.
Hey, Mandy, Tim. So I think what you're also saying is the other side of that, and we've been all week talking about measuring where the weighting of the market is overall and the dominance of mega cap tech. And essentially, that's where people have been hiding out. And of course, hiding out means markets move higher. Do you believe the headline indices can run into some pressure? Because it sounds like the trade you're talking about is the cyclicality that's seen the negative headwind. And that the other side of that is that mega cap tech is something that may be vulnerable if people are actually accelerating their risk.
Sure. So we could see a rotation out of the mega cap techs into the more cyclical sectors. I do think kind of in an environment where cyclicals do well, I think tech would hang in there. So I think on an absolute basis, I think the sector still does well, but on a relative basis, that's when it's going to underperform. And that's kind of what we saw in the first quarter of this year was, tech still did okay. It was just underperforming the cyclical sectors.
And you said taper is not going to be a volatility event. It's going to be a snoozer.
Yeah, so exactly. So maybe a little contrarian take here, but I think if you look at historically what's been a catalyst for volatility, what's been a negative catalyst for market, it's not taper, it's not monetary tightening in itself. It's when that tightening is a surprise. So if you look, for example, in 2013, which was the last time the Fed tapered, really the sell-off came in May of that year, right? That was the first time Bernanke talked about tapering. It caught investors off guard. That's when we had a spike in the VIX, the spike in bond market volatility. But by the time the Fed actually got around to tapering by December of that year, stocks were higher, bond yields were high, so bonds sold off, but stocks did well. Volatility actually came in after the Fed started tapering or finally announced taper. So my point here is that, once it's well anticipated by investors, once it's kind of priced in, it's unlikely to be a catalyst, a volatility catalyst.
Mandy, great to speak with you. Thanks for your time.
Thank you.
Mandy Su. Nadine, where do you stand on this sort of contrarian notion that taper is not going to be anything for the markets in the end?
Well, I agree with Mandy. I mean, I think that, sure, you could see a couple-day volatility around any of these events, but we agree in that oftentimes tapering can be a non-event in the short to intermediate term if you're looking at the stock market. But instead, we look at options, as you know, Mel, and we see the same sort of, call it put or downside protection being layered on implied volatility premiums, so the protection people are on is getting more expensive. And so there has to be some sort of catalyst for that to unwind, so people to take off the protection and start buying into the cyclicals that she's talking about. But the asymmetry definitely is in the places she said. The only one I would add is the US dollar. That's probably, in my mind, the one of the most juicies. You could see the UUP, which is the ETF, declining from here. So you could actually short that or put protection on it and probably make a little bit more asymmetric money on it.
Guy, if we do see a bid for the cyclical sectors like this, like the financials, for instance, are the overall markets going to have a rough go of it?
It's interesting you mentioned that. We talked about that last night, right? Yes is the short answer, because if cyclicals, if the banks do well, I would imagine it's because rates are going higher. And although the banks are important, they're not nearly as big enough to support the broader market. So my suggestion would be, or my premise would be, banks going higher would mean rates are going higher, which would mean the stocks that really dragged us higher, the high growth, high valuation names are going to get whacked. So I think banks can go higher with the broader market going lower. Well done by you, Mel. You pay attention, which is the cheapest thing you can do.
And Tim has raised his hand, so I shall call on Timothy.
Well, I feel like we need to tie this up with, again, a reference back to Christmas shows and whatnot. And it sounded like Mandy thinks that tapering and the fear of that is much like the abominable snowman, who once Hermie fixed that tooth, he was really a nice guy, and he was a non-event. and you know, I feel we have some abominable snowman in our future.
Well done, Tim.